People call pairs trading a risk-free arbitrage. It isn't. The risk is real. You entered by the book, and you're instantly down. So now what? Over the last 4 parts, we built the tools of pairs trading, one at a time. The spread, 2 stocks turned into a single line, normalizing, putting 2 different prices on the same ruler, the cointegration coefficient, ETA, that tells you how many shares of each to trade, and the log spread, whose value is your actual return. So the toolkit is complete. But here's the thing. Having the tools and actually trading them are 2 different things. Today we go practical. The risk pairs trading hides, the step-by-step process the pros run before every trade, and a technique, synthetic pairs, that strips out one more layer of risk. This is where the tools become a real strategy. Let me be straight with you first. Pairs trading is often sold as a market-neutral, works whether the market goes up or down strategy. The market-neutral part is true, but risk-free is wrong. Think of it this way. When you just buy one stock, the risk you take splits into 2 layers. One is market risk, the part that comes from the whole index moving up or down. The other is individual risk. Whatever happens to that one company, earnings, an accident, a scandal. What pairs trading does is erase that first layer, the market risk. Buy one, sell the other, and when the whole market moves, the 2 sides cancel. Part 4's hedge ratio, ETA, is what tunes that cancellation precisely. But the individual risk and the risk in the spread itself both remain. Every risk we cover today comes out of that leftover layer. First, mean drift risk. The spread's equilibrium, the average line, mu, isn't fixed. We usually look at a rolling window, say the last 600 days. As time passes, new data comes in and old data drops out. So the cointegration coefficient and the average shift a little, and the equilibrium drifts with them. That's why the expected return you calculate at entry and the actual return at exit can differ slightly. It's not a big risk, but you should always check how far the equilibrium slides when the spread falls. Second, spread volatility risk. If the spread has a wide range or big day-to-day swings, your expected return goes up, but so does your risk. You could make a lot quickly or lose a lot quickly. Instead of eyeballing it, measure the variance, and to compare pairs, use the Sharpe ratio. Return divided by variance. Higher is better. Big return, small wobble. That's the pair you want. The third risk is the one that should scare you. Fundamental risk. It's the biggest risk in pairs trading, and the one that makes the stop-loss decisions so hard. Picture this. 2 rival companies that have moved together for years. The spread has always oscillated inside a steady band, and right now it's near the low. By the textbook, that's a good place to enter. So you enter, and then, instead of reverting, the spread keeps widening, breaking through into territory it has never reached before, and staying there. What happened? Something hit just one of the 2 companies. An accounting problem, a massive recall, a regulator, a core business falling apart. Something specific to that one name, the common thread that tied the 2 prices together, snapped. This risk exists in every kind of investing, so you can't remove it completely, but you can minimize it by running fundamental analysis before you enter, checking whether either side has an event brewing. If a spread has dropped unusually low, there's always a reason it dropped. The fourth one is more down to earth. To run a pairs trade, one side always has to be a short. You borrow the stock and sell it, and borrowing costs money, roughly 6% a year, more if the stock is hard to borrow. On top of that, if the borrowed stock pays a dividend, you owe that dividend back to whoever lent it to you, and you give up rights from things like share issuance too. It looks small, but it's a real cost bleeding straight out of your return. Your expected spread gain has to clear that cost for the trade to be worth it. So when you're shorting a stock around dividend season, or when there's a share issuance announcement, weigh it carefully. Now that you know the risks, let's look at the process that manages them. Pairs trading is a mechanical strategy, so unlike directional trading, where you decide by feel every time, you can follow a fixed procedure. There are 7 steps. 1. Set a target. Your capital, your target return, the risk you'll accept. For reference, the original author aims for 10 to 20% a year in practice. Simulations on past data can arithmetically show 40 to 50%, but you can't catch the exact low and there are costs, so 10 to 20 is realistic. That's an example, by the way, not a promise. 2. Select pairs. Pick pairs that fit the target for low risk, large, low volatility stocks, and check that they're highly correlated, co-integrated, and that the spread has no overall trend. 3. Fundamental analysis. Check each name for a special event. This is the step that screens out the fundamental risk we just saw. 4. Simulate. Use past data to set your entry and exit points and compute the realized return. 5. Risk analysis. Check the mean drift and volatility we covered over both long and short windows. 6. Paper trade. Run it with no real money. 7. Go live. And this loop doesn't end after one lap. Your live results feed back into your target and your pair selection. Here's a key point. Why does this process actually work for pairs trading, of all things? In ordinary directional trading, people say paper trading is close to meaningless. You do great on paper and then can't make money live because you're swayed by market conditions and your own psychology. But pairs trading is a mechanical, market-neutral strategy that's far less sensitive to either. So your paper trading results come out close to your live results. That's the decisive difference. Your simulation and your paper trade actually have predictive power. It's why simply setting rules and following them becomes an edge. Once you go live, here's the truth you'll meet. You'll very often start at a loss. You think you're at the low, you enter, and the spread widens further. This is where beginners crack, but here's where it splits from directional trading. In directional trading, the trend is alive, so a price can fall forever. Cutting fast is often smarter, but the spread of a coin-integrated pair has no trend. Only the residual is left. If you picked the pair well, there's a real basis to wait through an early loss for the reversion. Of course, if the pair selection itself was wrong, if the fundamental risk we saw just fired, then you cut. The point isn't that you never use a stop, it's that constant stopping is unnecessary. So how do you set the stop level? There's a neat paradox here. Set it high, say -5%, and you avoid big losses but you stop out often. Set it low, -30%. And each loss is bigger but rare. Do the simple math and the expected value of the two is the same. So the stop level isn't decided by logic, it's a matter of your temperament. One reliable tip though, nobody catches the exact low, so don't put it all in at once. Scale in around your entry level. Your average cost lands near the low and your risk goes down. Finally, a technique that strips out one more layer of risk. Synthetic pairs trading. Until now, it's been one stock against one stock, but one side of the pair can be a basket of several stocks. The method is simple. Take the returns of stocks A and B and take a weighted average at whatever ratio you like. Say 60-40. Build a new price series from that blended return, and you get the price chart of a single portfolio. A and B held in that mix. In effect, you've listed a brand new stock that doesn't exist on the exchange. The classic case is a holding company versus its subsidiaries. One holding company has several listed subsidiaries, so you combine the subsidiaries by their ownership weights into one synthetic name and pair it against the holding company. Then you trade that synthetic against another name or another basket. Why go to all this trouble? Go back to that risk split from the start. Remember, total risk broke into market risk and individual risk. Pairs trading erase the market risk, and the synthetic erases the individual risk. Put several stocks in a basket, and if one blows up, the whole basket barely moves. That's Markowitz's diversification principle, the idea from 1953. So a synthetic pair cuts both the market risk and the individual risk. And there are two bonuses. One, a one-to-one pair just waits for the spread to fall, but with a synthetic, you can tune the spread's shape by adjusting the weights, setting them so the expected return is as high as possible. 2. The number of possible combinations explodes, so you get far more chances to find a tradable pair. Lower risk, return held, or even higher, more opportunity. Just don't forget, the spread can still break on its own. That last layer remains. There's no such thing as risk-free. Let me bring it together. In this series, we first built the tools, the spread that turns two stocks into one line, normalizing that puts them on one ruler, co-integration that sets how many shares to trade, and the log spread that reads out your return. And today, we put those tools to work in practice. the risks that remain, the 7-step process that manages them, and the synthetic pair that strips out individual risk too. The one line I want you to keep is this: pairs trading erases market risk. The synthetic erases individual risk. And there's still one layer left, and handling that last layer is what separates the pro from the beginner. There's no risk-free arbitrage, but the discipline of peeling risk off layer by layer and managing what's left, that's the real power of pairs trading. One thing to be clear about: today was about how pairs trading works. It is not financial advice, and those return figures are illustrative, not promises. The final call is always yours. That's it for the fundamentals. From the tools to the practice, you now have the whole skeleton of pairs trading. If this helped, please like and subscribe, and in the comments tell me, which 2 stocks or which basket would you build your first pair from? I'll see you in the next one.